Afternoon. Great to have you with us on this Tuesday afternoon. Today we've got two great guest speakers. Normally we only have one, but we've decided to break it up a little bit today. We've got our own in-house investment specialist, Mr. Leon Marais, that's going to talk a little bit about retail saving bonds and SA bonds and cash. We get a lot of questions currently from clients about bonds, and just like when the downgrade was happening, we had a lot of questions about what's going to be the effect on bonds, and now everybody wants to know, is bonds maybe a good option to be in? And then we've got a special guest speaker, Karen from Foord. She's going to talk a bit about how Foord Assest Management approaches things and how they position their portfolios to make sure that they give us alpha, or they give us the upside. So I've got Leon already standing by to start with his presentation. We've got a couple of people still joining us. Just for the clients that's joining us for the first time, please make a note in your diary. We've got this functionality or this platform every Tuesday afternoon, or every Tuesday, once a week, Tuesday afternoon at 4 o'clock. We're going to talk about different topics. We're going to start not only talking to asset managers, but we're also going to start talking about a little bit more specific topics. But you'll receive an email during the course of the week inviting you, and we'll give you a little bit of a heads up on what the topic will entail, and you can see if it's interest to you, and then just join, register. We'll also send you the recording, we'll send you the presentation, and please, if you've got friends and family that you might find this or might find these webinars or topics interesting or add value to them, please share the email with them, share the links with them. Anybody's welcome. It's not a closed platform. The more people that can benefit from this, the better for all of us. So without any further ado, while Leon joins us, please look, there's a button on your screen that says schedule a consultation. If you wish to speak to your advisor or an advisor about a specific topic, or just request a phone call, just click on the link. It will take you to a page and you can schedule an appointment. All right, so let's have Leon joining us. There we go. Thank you, Leon. Appreciate your time this afternoon, and hopefully we can bring some excitement regarding bonds. Like you always say, bonds is not the funnest thing to talk about, but give it your best shot. Thank you very much.
Thank you, Barry, and welcome and good afternoon to everyone. So yes, we've been getting quite a few questions about retail savings bonds and do they add value, and then also combined with all the interest rate declines that you're lowering that we've seen from the Reserve Bank, it's becoming very hard for people to invest in a money market or at the bank in a fixed deposit because the rates are so low. Currently, you can expect a money market rate of about 4.5% over the next 12 months, which is considerably less than the 7% that we saw typically over the preceding 12 months. So just in brief, what we're going to be talking about, firstly, what is a bond? Why is everyone talking about bonds? How do interest rates affect bonds? How are bonds taxed? What are the risks and alternative options? So firstly, I decided to look at what is the definition of a bond. So Investopedia defines a bond as a fixed income instrument that represents a loan made by an investor to a borrower. A bond is basically an IOU. So an institution or a government or a company loans the money to someone, and then there's an interest payment on top of that. So what the big question currently is what's happened in South African bonds. Now, it's been coming a while since Nene Gate, which was the end of 2015, where there was a lot of talk about South Africa becoming junk status, or our bonds being downgraded to junk status. So everyone was scared about this and what the implications would be. But due to the long time frame that we had with all of these possible downgrades, lots of these movements were already priced in. So then when it finally happened, it also happened at quite a bad time with the COVID-19 situation, all the lockdowns all over the world. So what was the implication? So South Africa's got the 6th most liquid bond market in the world, which means there was a dramatic sell-off. So people all over the world who needed money in a panic frenzy that, like we saw on the markets, came to South Africa and said, we'll take our money out of here. We're typically going to gold, or we're going into dollars, or what the case may be, safe haven assets. And unfortunately, South Africa and its bond market, and then also the currency, took a big knock because of it. Foreigners sold 53 billion rands worth of South African bonds in March and another 10 billion in April, which is massive amounts. So interesting enough that the movement, because of the junk status, which was only end of April, was actually quite a bit less than the actual movement that was caused by the COVID-19 panic. So obviously this resulted in South Africa becoming being classified as junk status. And junk status basically just means that it is a more risky investment. So obviously, if I know I'm going to get my money back from if I give it to someone, then typically I will expect a lower interest rate. If there's more risk involved, I want higher returns. And this is typically what's happened in South Africa and has been the case for quite some time actually. The big question that we get quite a lot is retail savings bonds and what the interest rates on those are. So the table I've included is the current interest rates that you can get if you just plain Google reserve or RSA retail savings bonds. You get the fixed rates or you get the inflation rate bonds. So obviously the fixed rate bonds at a 10% over 5 years is looking very attractive. And this is similar to what you can get in the bond market as well. You're looking at a 10 or 11% return. But it is obviously there's a little bit of a disclaimer. One has to look at what you are investing in and what the terms are of those. There's also inflation-linked bonds, and always interesting enough, if you just compare the 3-year inflation-linked bond to the 3-year fixed-rate bond, the differential is basically the inflation that's been priced in. So you can see on a 3-year term, it expects about 4.25% inflation. On a 5-year bond, it expects inflation closer to 6%. So then you can also make your assumptions, say, well, what do I expect inflation to be? And that will help determine your decision whether you go to the fixed rate bond or the inflation-linked bond. Firstly, how is a bond priced? Bond yields depend on the underlying risk of the investment, like I said before. So the more risky the investment is, the higher the return you typically get. And then obviously also the term or the duration of the instrument. Is it a 1 year? Is it a 5 year? A 10 year? I know Disney, the movie company, brought out a bond a few years ago that was a 100-year bond, which is an extremely long period to have in a bond. This obviously comes with its own sets of risk converted to that. So if we look at an example, just a very plain example, Good Forsure Blue Star issues a 5-year bond at a value of 100,000 Rand with a 10% annual coupon. I just said it's linked to prime interest rate, what it was a few months ago. So after 5 years, the investor will receive the initial capital of 100,000 back, and they would also receive at the end of each year a 10,000 Rand coupon. That's just simply the 10% times the 100,000 initial investment. So in total, the investor would get the 100,000 plus 5 times 10,000. So it would give a total 150,000 out of the investment. Now, just to illustrate how these bonds get affected by interest rate movements, I lowered the interest rate on the bond to an 8% return, which means now the annual coupon would go down to 8,000 Rand per year. If the maturity value stays at 100,000 and all the other terms of the bond stays unchanged, it means that to adjust for the same level of risk and return, the value of the bond increases to 110,000 initially. So then simply put 8,000 times the 5 years, that's 40,000 plus the 110 puts you in the same as 150 as in the initial example. And it illustrates the point that as interest rates go up, the capital value of a bond goes down, and vice versa. And we looked at another example. If interest rates were to go up to 12%, the annual coupon would increase to 12,000 Rand a year. That means that the initial capital value would decrease to 90,000 Rand. It just illustrates that bonds are not always there is capital movement on these bonds as well. Typically, if I was the investor in the initial example, I invested, I keep my money for the 10 years or 5 years or whatever the term would be, I have quite a big amount of certainty of what my outcome would be. But 5 or 10 or 20 or even 100 years is a very long term to be invested in a bond, and also the underlying risk that the company or the country poses. And that's where we typically see these big movements that can happen. So just in a comparison between the 3 different examples, the different interest rates change, and then the dark blue is the capital value, and the light blue is the coupon rate. It comes down to the same effect, but the market, the interest rate movements determines the combination of what the returns will look like, how much is capital and how much is coupons that you would receive. Then if we bring it a little bit closer to home, this graph, first thing, if you first look at this graph, you think this is the JSE so far for the year. Well, actually it's not. The big movement that we've seen there is the all bond index of South Africa. And it just shows how big a sell-off we've had in these bond markets. Now, typically, while we've had this big drop in the bonds, it means that the bond yields or the monthly interest that you would receive on these bonds increased dramatically. But because of the inverse relationship between the yield and the capital movement, we saw this big capital sell-off. And then obviously these very low level at high yields is an interesting opportunity for fund managers or investors to enter these bonds at an 11 or 12% interest to maturity. So typically a lot of fund managers and also overseas investors has been taking up some of these bonds at these levels. And that's where we're getting a lot of questions saying, well, bonds is actually a good opportunity going forward. And we agree with that, but obviously we must also understand what the implications would be. If we have another sell-off in bond markets, or if there is a default in terms of South African debt, which is a concern at the levels it is, and increasing at this stage, then there is some risk to capital as well with a bond. Like we've seen in the land bank recently, which has defaulted on some of its debt. So there is always a bit of a risk involved. The darker line, more solid line, is typically that's the industry average for the income funds or short-term interest-bearing funds in South Africa. And you can see that there has been a capital movement there as well. It's not as a straight line as it was, but it's a lot more consistent. And it's typically in a shorter dated bond. Now, obviously, the longer the term of the bond, the more impact it can have on interest rate movements. The shorter dated bonds have less impact or is less affected by interest rate movements. Then if we move on to how bonds are taxed, now bonds is mostly interest. Now you get an annual interest exemption, 23,800 Rand if you are under the age of 65. If you are over the age of 65, you qualify for a 34,500 interest rate or interest exemption. And then obviously if you are trading these bonds and not just simply holding them to maturity, there could be capital gains and losses. And that we would have seen in a typical bond fund over the last few months, that there would have been capital losses on these funds. Then obviously we have to look at what are the risks in bonds. Now obviously default risks, so that could be the company or the country that you are investing in, their ability to repay debt. And specifically on the retail savings bonds, is the South African government's ability to repay the debt. Now we all read the news and we know what's going on in terms of currency or the debt that we have in our country, and so it is a concern. There needs to be growth to be able to pay this debt. So unfortunately, bonds don't come without risk. Then also there is liquidity risk. So that means if I need my money available, if it's in a fixed investment at RSA retail savings bonds, you're typically looking at a 5 or 10-year investment term where you can't access your money. You get your coupons, you can have that paid out or reinvested, but typically you can't access your capital. And then also the inflation risk. Now currently with the low oil price and low global demand, inflation is low and it's expected to stay low. But with all the quantitative easing and money printing and money that's being pumped into the system, we can expect that there will be rising inflation, as we can see with the gold price that already is very high. And a gold is typically a good hedge against inflation. So there is a concern that inflation could be a problem. And that's where if you go into an inflation-linked bond, it's probably a better situation. Whereas if you just go into a nominal bond at this stage, 6 or 7% might sound very attractive now, but if inflation is sitting at 8 or 9%, it could be a very, very big problem. So it's not always a clear-cut decision just to say, I want to go into bonds, and especially if you go as an individual investor and there is a fixed term combined to it. So what are the alternatives? What else can I look at? Obviously, money markets are giving us lower returns, and we can expect that to go even lower over the next while. Firstly, I've got a graph up here of a 3-year return, cumulative return. You see the middle one, the pink color with the step up. That's the money market returns that we've had over the last 3 years. it's been fairly good. We can expect this to, like I said, average around 4 to 4.5% of the next 12 months. You can also see the line at the bottom, that's inflation over this period. So money markets have actually compensated investors very nicely in relation to inflation. And you would typically expect money market to outperform inflation by about 1% per year. So this is actually a bit of an anomaly that we've got this big returns here. And then at the top line, a more consistent line, we're talking, that is a product that Glazier is offering. It's called the Glazier Cash Option. There's no platform fee on the product. It's a nice parking space for investors. It provides a return a little bit more than you would expect from a money market typically, but it offers liquidity at all times. So you can access your money if you need it. You're still getting a good return. Typically, it's difficult to say exactly what the returns will be going forward, but you would expect about 1% above money market. So if we're saying money market's 4 to 4.5%, you're typically looking 5 to 5.5% out of these type of products, which is not a bad return at this stage, especially if you're looking for a safe position to park capital this stage until there's a little bit more certainty. And especially as an alternative, you where you're getting a 1 or 2% at the bank. And sometimes you get a little bit more, but then it's fixed for 5 or whatever period. Then as another alternative, if you want to look and say, I've got a big amount of money that is sitting in money markets or cash investments, and then obviously the component that goes with that is the tax component. And you want to say, I want to invest a little bit more tax efficiently without taking on too much extra risk. I've taken the same graph, but just replaced, you'll see the money market line is still there, and we've still got the inflation rate, but the more volatile line, although it is a little bit more volatile, it follows the money market line quite closely. And this is the low equity investment fund category in South Africa. It has done quite well over the last period. The previous 2-3 years, it has struggled because conditions has been quite tough. But even with difficult conditions, it still matched what you could typically get in a money market, but way more tax efficient. So it is alternatives to consider. It is difficult times. But there is always an option to say, well, I want to move out of a money market or a deposit at the bank, or what the case may be, even if it's just parking it in a cash option at something like Glazier, or more looking at a little bit more of a market exposure to be a little bit more tax efficient, there is options to consider as well. I'm going to hand over to Karen, then she's going to say or tell us about how Foord also uses their portfolios to use some of the bonds, and then obviously Foord is a little bit more of an equity manager, and seeing how they currently position their portfolios. Thanks, Barry.
Thank you, Leon. We're just waiting for Karen to come on screen. Let's just quickly see. Karen, we'll see. Hopefully we don't have the same issue as the other day where we have 2 Karens. I think that has actually happened. I think it's actually Karen Ferreira that I invited on screen. Now I've invited Karen du Toit. So Karen will, there we go.
There we go.
Welcome, Karen.
Thank you so much.
Okay, I'm going to hand over straight to you. Just a quick introduction. Karen joined Foord in 2016 as head of retail for Northgard. Before Foord, she did a stint at Allen Gray and Stan. She received a degree in communication from the University of Johannesburg as well. She did a postgrad in financial planning from the University of Free State. And she's been in this industry for quite a while. We are very honored to have you speak to our clients today. And there's some Q&A, so everybody listening, please, if there's something that you'd like to ask Karen about Foord and how Foord goes about doing things and how Foord fits into Good Forsure's portfolio, I'll open it up at the end of the day or at the end of the presentation for Karen and for Leon to answer some questions. Thank you very much.
Thank you very much. So I just want to change my view here. Alrighty. Okay. Thank you so much for this opportunity. It's always so nice for us to be able to talk to the end client. I think people tend to think we're very far removed, and I think advisors you have a tough job because you're at the coal face dealing with the emotion. But I think a lot of the time from the advisor, we then get the emotion, and we completely understand that this is a really trying time for everybody, with a lot of uncertainty and that sort of thing. So really, just touching on what Leon said, I obviously we don't have income funds. So unfortunately, for those questions you've been getting on going into bonds and that sort of thing, we don't have a specific income fund. But how I'm going to be chatting through part of my presentation, I will be touching on where bonds fit into our portfolio. So really, I mean, and on our investment process, just to give you a little bit of background there, is that so you may have heard from a lot of fund managers, so just to sort of chat about, a lot of fund managers would say they're valuation based, or they like to buy shares that are below the intrinsic value and then sell them again when they've gone above that value and that sort of thing, that the macro environment doesn't play as big a role. They sort of tend to call themselves bottom-up managers because they first focus on the company and then the industry and then the macroeconomic environment that company fits into. Whereas we say we're bottom up and top down. So what that really means, and we've tried to put it into this picture, is just we believe that the macroeconomic environment plays a very large role in how we look at the world. Because if you think about it, the companies that you're buying and the shares that you're buying they operate in this macroeconomic environment. So that is an important part of how we look at that part specifically. And then given given macroeconomic environments and also specific scenarios that we would then be looking at, we then go look for companies within that specific scenario and macroeconomic environment that would then do well in that sort of environment. Why I'm talking about this is because I'm about to bombard you with a lot of slides on how we see the world, but that really, and at the end I'll bring it together, but it does play a large role in how we've positioned our portfolios. Just an important thing is the companies that we would then look at. So we have a huge focus on quality companies that have a sustainable competitive advantage, or often you'll hear fund managers talking about a moat. So like castles had a big moat built around them that could prevent people from getting into the castle. We like businesses that have this moat around them that make it very difficult for competitors to come into their industries. Obviously, good growth prospects, sound balance sheets, and strong management. Management is hugely important because it will, that management that has successfully navigated a company through environments and helped the company to grow their earnings is the same management that would potentially make the right decisions going forward on how to steer that company. So it actually forms part of our risk management. So you can team up, or you can buy a company where there's good management and they're steering that company in the right direction, and you just get to go along for the ride. So a good example of that would be like a Naspers, where Naspers found that they were in a dinosaur or dying industry with magazines and newspapers. They identified the whole pay TV sort of trend and bought into that, and they've also realized that potentially, your DSTV and that sort of thing may be a dinosaur industry going forward if you look at the rise of the Netflix and those kind of things. And they've branched into that whole Chinese internet, that Tencent, the gaming and that sort of thing. So really good management navigating a company forward. Earnings growth is important, and the predictability of that. It's a lot easier if you've got a nice, predictable, slow and steady, wins the race kind of company that every year grows its earnings. We like that predictability and the reliability. Strong cash flow, dividends are important, and then obviously the price that you pay for the company is obviously important. Everyone likes a bargain, but I mean, it is important. Your entry point there will determine your return going forward. Just an interesting thing, I have in my dealings with clients, I've been picking up a lot that it would appear that a lot of the asset managers are not now talking about quality companies. So I'm being told, yeah, but it doesn't really make you different, because now it seems that everybody wants quality companies. So our positioning hasn't really changed in the last 4 years. So we've been in those companies. I just think that there's probably, your quality companies are probably going to weather this storm, a lot better than smaller or very niche kind of companies. I've now been, as mentioned, at Foord for 4.5 years now. And the interesting thing is we've been saying the same thing for 4.5 years. I think it probably sort of the catalyst came at the beginning of the year, but for 4 years, I've been telling clients we are cautiously positioned. We are concerned about these long economic growth cycles we've seen in the world. Everything works in a cycle. It ebbs and it flows. And we've had this long economic growth cycles. We've had these long bull markets, and we are concerned that these are all running out of steam. Now, obviously, I can honestly tell you we didn't know coronavirus was going to be the catalyst, but this is a graph that we showed at our roadshow in January that shows the S&P, which is the black line, and then the red line at the top is a forward price to earnings ratio of 19. For the gray line, at the bottom is a 14 forward per PE. And really what we were saying in January, and that's the graph we used, is that when the market is this expensive, so i.e. it's that close to the 19 PE, where historically it's been around it's usually around 16, 17, we were saying this concerns us. And the problem when the market is this high is it doesn't absorb shocks very well. And like I said, we didn't know, we knew about coronavirus at that stage, and thankfully we have an offshore office in Singapore, and so they're sitting right there in the eye of the storm. And the guys were saying, we don't think the market is appreciating the seriousness of what this is. So what we actually did do in January is we started to build protection into our offshore funds, which basically it's a put option. So what we're basically saying is that we think the market is going to fall, so we will buy it here at a higher price. And on the other side of that bet, I can put it that way, it's not a bet, it sounds we don't gamble, but at the other side of that, there's someone that says, well, sure, we think the S&P is still going forward. And if you think about the world in January, that really was where we were. America was at record employment levels. There was still lowering of interest rates, so that it was all very positive for the S&P. And so obviously it was easy to find the person on the other side that said, oh, well, we'll buy it because we think the market's going to go up. And we were saying we think the market's probably going to come down. And those added to the alpha we were able to create for clients, that protection that we built in. So the picture now, it's a completely different picture. So we all know, the market fell. I think I read this morning, one of our colleagues saying that the S&P is testing or it broke 3,000 again. But really those 19 and 14 lines have come down, which could be earnings that are coming down substantially, or the price of the market, one of those variables. Just our outlook going forward, and as I've mentioned, it is important for me to bombard you with all these really boring graphs, because I will pull it together at the end to show you how we've positioned ourselves for this. But really, there was this huge shock. This is forecast by analysts, so this is not our base case, because you can see that going forward, they are pricing in world growth. So this is the GDP growth number, and they are pricing in growth. We are not quite as convinced, because really, we don't know how long is this lockdown going to go on for. Some of the economies have opened, obviously, but what if a second wave comes and they have to close again? So the market, we feel, is probably a little bit optimistic about the recoveries of a lot of these economies. And the other thing is that once the economies have opened, how many of the companies are going to be surviving? So that's all stuff that we are quite concerned about. And we're not quite sold on the case of that there's going to be a huge recovery in the economic growth. Also, as I mentioned just now, we came into the year and unemployment in the US was 3.6%, and now we're sitting with a 14% unemployment rate in America. So a lot of the jobs that were created since after the great financial crisis are having wiped off the table, which is a concern, which is obviously something that then again impacts forward on the economic growth coming out there. And this is happening globally. So I'm talking about America here specifically, but really this is a global occurrence. And I think, obviously we all know in South Africa, we're probably going to see the same thing happening. So earnings is reality. So when you buy a share, you're buying the cash flow that is going to come out of that company forward. And we've seen, again, earnings coming out of the estimates or forecasts from the analysts saying that there's probably going to be about a 50% contraction in the earnings of companies in 2020. So what this graph shows is what we've had, and if I can just focus your attention on the March 2020 dot and the the now dot. And really what that shows is if you go down to the horizontal axis, you'll see that now there's that 50% contraction in earnings. So that the horizontal axis is that global earnings per share change. So you've got the contraction. However, at the moment, and if I can focus your attention to the now dot, the market's only fallen just about 20%. So if on the next slide, there's a bit of it. So if I can also just ask you to notice where the 2007-2009 dot is. So we had a 60% contraction of earnings and the market fell. The MSCI All Country World Index fell with 60%. And if you look on the next graph, so the red line is the 2020 graph, and the green line is the 2007-2009 graph. So really, if you see all the dots here, they're pretty close. The earnings contraction now is not that much different from the financial crisis, yet the market has only fell a little bit. And we actually, a lot of people say now, oh, but the markets are recovering and it's looking good. And yes, but if you look at where the red line is currently, it touches the green line. So basically we are now exactly in the same position we were in the great financial crisis. That's now 3 months in. So that's the horizontal axis. So, but you can see it was a sharp fall and a recovery. And we basically think it's a rally and a bit of a bear market. But I mean, this broke a lot of records. So it dropped with 20% in 20 days, whereas in the financial crisis, it took about 250 days to get to go into bear territory. So really, this has been the fastest progression that we've seen into a bear market. So there's a bit of a disconnect at the moment. You are seeing, or hearing the S&P testing the 3,000 levels again, or it's doing better than that. But the problem is there's a disconnect between the earnings components and then the shape at the price of the index. And that concerns us because that dislocation might correct with the price moving closer to what realistic earnings are. Of course, we know that the Federal Reserve reacted on this. So why have the markets rallied? Because the Fed jumped in, and of course a lot of the other central banks in the world. So the Fed lowered their rates and they're sitting on 0.25, so obviously very close to zero. And while they said they're not going to go down the whole negative policy, negative rates, who knows? Nothing, I think, is nothing would surprise anyone at this point in time. But basically, the Fed can support the markets by lowering interest rates, and then of course that whole purchasing of securities, so bonds and mortgage-backed securities and that sort of thing. And now obviously the term quantitative easing is something we've become familiar with. So we've seen interest rates going down in America again. And as we can see here, so this is now the global central banks, but you've seen this huge purchasing of these securities. So buying back bonds, buying back instruments so that you're able to put that money into the market so that it can be used by consumers and the public to spend, which would stimulate the economies, etc. But, and I mean, America, and sorry, the graph on the left is the 12-month rolling. So it's 12 months, moved on with 1 month, 12 months. And all I'm trying to show here is you can see the response that's been from all these central banks in this, to the COVID virus. It's been enormous. And this is coming off a place where the Fed actually began with a sort of a normalization process where they were saying we're not going to be buying back these securities anymore to a lesser extent. And of course the COVID virus has just, the coronavirus has just made them do a 180-degree turn on that strategy. And then really just on the right-hand side is the central bank security purchases as a total. And we're talking trillions of dollars here. So as my colleague says, we're talking about 12 zeros, huge numbers. And I mean, even the Fed is now buying corporate credit. So usually they were looking at government bonds and that sort of thing. Now they're even buying corporate credit, which is also, again, another historical move. So we're hitting all these. This is a time for the history books, I would say. And then just lastly, I mean, just on the same point as the government spending. So again, we see here on the left-hand side, I mean, the GFC, you see what the government was spending to try and stimulate their economies, and this is the response of to the virus. And then on the right-hand side, I mean, you can see that, the Fed is now in a 19% deficit. So they are spending more than they're collecting via revenues. So on the South African picture, so unfortunately, we've seen a huge, this is a forecast. So while that axis ends at 2018, it does go on. So this is that red line is 2020. And again, this is forecast from analysts, but really they're forecasting a 10% decline in economic growth, a growth rate of minus 10%. So it's a huge number. And I think the SARB came out and said they're looking at about a 7%, minus 7% GDP growth. So really big numbers. And unfortunately, we were already in a tough position going into the whole virus. So this is really a tough position for us to be in. And if you look at the response that we've had to this whole coronavirus, I mean, we're second. If we look at this as an emerging market, the responses in sort of relief packages and stuff that is coming, that the IMF has been tracking. And if you can see, we're second, and this is your fiscal response as a percentage of your GDP, but we're just second to Singapore. This is a country that has a far better savings rate, growth rate, and that sort of thing. So we've done a huge response to this thing, and we're not actually we're in a very difficult financial position, not really in a financial position to be throwing this much money at the problem. So even before COVID-19, our public finances were in a bit of a lot of trouble. And I mean, that was something, again, this is the same thing we've been saying as a company, as Foord, we've been concerned about this picture. And often people say to us, you're so negative. But I mean, again, this is part of how we invest money. This is part of how we manage risk. But this has been a picture that's concerned us. You can see here that we're in a fiscal deficit. So we are spending more money than we are able to collect. And I mean, SARS has, and we've now just launched this relief package, this 500 billion relief package, and SARS is projecting that they're going to collect 285 billion rand less. There's going to be a shortfall in tax collection. So this is a very concerning picture. And I mean, it's something that Leon touched on just now, and I will talk about. But remember, this is the kind of stuff that your investors are looking at when they're buying long-dated bonds. They're looking at what's your financial position. Can you give their money back at the end of 20 or 30 years, depending on what the bond is? So this is all stuff, people looking at how you can finance your debt, what's your money management like. So I think if you were to lend money to a relative, you're like, oh, but this guy he's in so much debt. I don't know if I'll ever see this money again. It's the same thing when you're buying a bond, or that's what your investors look at. So this is This is also a graph we had at our roadshow in January, but it's just a little bit different. But I mean, really, in the 2020 budget, that dotted blue line is what governments, budget that they forecasting debt to be. So 2020 they were looking at about 65% debt to GDP. 2024 you can see it's sitting around 70%. But unfortunately, I mean, you can see Standard Bank, and that's the solid blue line. Standard Bank is forecasting, and if we look, say, if we look at 2020, Standard Bank's forecasting about 80%, as is, and the bearish scenario where we have 1% growth is, and no wage, no savings that we're able to save out of the public sector wage bill, then we're still looking at about 80%. And that's a bearish thing. And even if we let's look at a good situation. So a good situation would be the green line, and where we would grow our economy would grow at 3%, and we're able to save some money on the wage bill, and there's some efficiencies in government running departments, etc., and spending and that sort of thing. We're still looking at a very close to 80% debt to GDP in 2020. So the scenario, it has worsened somewhat. Leon mentioned cash, so we also, I mean, I think especially when there's volatility, uncertainty, people want to go to cash. But as we've seen, we've had a 2.75% decrease in interest rates just in this year. And if you look at the bottom graph, so 3-month NCD, negotiable certificate of deposit, or 6 months or 12 months. So it's basically, I'm lending the bank money for 3 months. So, or 6 months or 12 months. You can see that those rates, the rates you would get, so if I lend for 12 months, I would get 4.78%. So you can see the rates there are very, very low in cash. So cash, unfortunately, and Leon did touch on it. So cash, I think it's important, and I'm not allowed to give advice. I don't know which each and every person's situation is, so I can't give advice. But I think, when people go to cash out of fear and that sort of thing, you just got to remember, and we use cash as an optionality, and I think that's what Leon said as well. It's that parking space for when you want to go into the market or whatever the case may be. So as a short-term parking space, by all means, but if you're thinking, okay, this is now where I'm going to put all my investments for the rest of eternity, it's quite a dangerous thing, because it kind of, the risk then is the inflation, beating inflation and all those fun things. But like I said, I'm not the advisor here, so I don't want to give too much on that point. So where do we have bond exposure? So as Leon said, so what we do, and we don't have an income fund, but our funds are what we call asset allocation funds. So on the risk of the fund, the mandate, the type of client that's in the fund, we would have exposure to cash, bonds, shares, property, offshore exposure, etc. And what we've had in the portfolio, so probably about 2 years, is quite a whack of bond exposure. So if I say whack, I mean our balance fund is a medium equity fund. So I lie, it's a high equity fund. And it has about 17-18% in government bonds. Our conservative fund, which has got about 24% in bonds. So obviously, given a conservative client's a little bit more cautious, etc., than the balanced client, would have more bond exposure. But it is because we've actually been saying for quite a while, and I'm gonna jump here, sorry, we've been saying for quite a while, is the reason we have bonds and we like bonds is because we get about a 9% return out of them. And if you, and I mean, this is probably just, it's a simplistic diagram, and it's actually old because inflation is now closer to 4%, or 3.4 something. So the thing is, if you're getting 9% guaranteed every single year, and inflation is 4%, then you're getting a good 5% above inflation return. Even if inflation, I mean, obviously that running yield, that 9%, does change every day because obviously bonds are trading on the market, etc. But even if you're getting 8% and inflation is 4%, you're getting 5%. And so we've actually, and again, when you're investing money, you've got to say, well, what can I buy versus what are the other things that are available for me to purchase. And if we're looking at a fairly uncertain world, some uncertainty regarding where we're going to be able to get those earnings growth and everything, and where can we get a 5% above inflation return fairly certainly in a share versus in a bond, and therefore we've decided, bonds are our preferred asset class at the moment. But a lot of the bond, and you'll see it says the R186 government bond. So that is a 10-year bond. It matures in 2026. And the benefit of these kind of sort of shorter duration bonds is, what it means is that when we say it's the sweet spot, because when you buy a bond, you want two things. You want, if I hold it to maturity, which is, as I mentioned, 2026, if I hold it to maturity, will I get my money back? So can that government pay my money back? And secondly, how liquid is it? So can I sell it in the market? So if we do see a better opportunity somewhere else, we may be selling some of this exposure, but can we sell it? We need to be able to sell it. So those are the two things you look at when you buy a bond. And in this specific bond, you've got that liquidity. It's a highly traded part of the market. So you've got those buyers that want it. And also, we believe that the government would in 2026 still be able to pay us our money back. So a lot of our exposure, probably around 86% of the bond exposure we have sits in this R186 government bond. We have bought a little bit on the longer end, so there where you're getting 10% and 11%, but remember, and it's something Leon mentioned as well just now, is that when you're on that end, like the 2038 and 2045, that whole thing about can the government pay me back my money, and as I mentioned, the uncle that wants to borrow money, that's a little bit dodge, he can't even pay his house and his car and he wants to borrow money. It's that kind of scenario. That's why the health of the government, the ability, how they manage their finances and that sort of thing is so important in this specific space. Sorry, I'm just going to come back. So what happened was in March, bond yields spiked. Now remember, a bond, so when they quote bonds, they say there's a yield of 9%, but a bond's yield and its price has an inverse relationship. So when the inverse being when the yield spikes, it means the price has fallen, and when the yield drops, it means the price has risen. So in this graph, what you see is when the yields spike, it means the price of the bond dropped. So we bought some of those bonds again because the price dropped, it became cheaper, and we took a little bit of advantage of that. And as I mentioned, and what concerns us a little bit at the moment is the bond yield has steepened. So what it says is, if you look on the left-hand side, that's your shorter duration, and then right to the left-hand side, you'll see, to the right-hand side, it says 30 years on the horizontal axis. So those are those long-dated bonds. And as Leon mentioned just now, when that curve steepens, obviously we've seen in the shorter end, the interest rates have dropped, so those rates have dropped. But the steepening of that curve is concerning, because what it's saying is that your yields are moving up because people want to be compensated. They want to get more yield for taking on the risk of holding a South African government bond for 30 years. So that's what that steepening of that curve means. And it also means that there's concern, the market is and investors are concerned because they feel it's more risky to invest in a longer dated bond, given the way that the South African government, the debt, the economic growth, the way finances are managed, and that sort of thing. And that's what it's a risk premium. You have to pay people, you have to compensate them for taking the extra risk of investing in your bond. So as I mentioned, this is just a simplistic diagram as to why we like these bonds. And just lastly on the Rand, it's always a hot topic. How we look at the Rand. So we get a lot of questions on the Rand. Where is it going? Has it not overshot where it should be? It's, isn't it going to go back to 16 Rand or whatever, and that sort of thing. So how we look at the Rand, one of the big things we look at the Rand. So we don't know where the Rand's going to be in 3 or 6 months. We have no idea, because there's so many other factors that impact what the rand does. It's a lot of what's going on in the offshore markets as well, etc. So from a 3 to 6 month perspective, we don't know where the rand is going. But an important part of how we look at the rand is the specific graph. So if you look at, I've just the black line that you see here is the unit labor of cost. So what that means is that we're manufacturing stuff in South Africa and we want to export it, but our labor costs are higher. So for us to manufacture that thing, we may be competing against another country that's labor is a lot cheaper than what ours is. So our item is more expensive to make, and then obviously it costs, the people importing it more money. So you're competing against other countries for those exports. And the only moving part is that your rand, if it weakens, or it's a more attractive buy for the it's a more attractive when your rand weakens, that's the only moving part to make that item more attractive. So basically, and then the shaded areas is just whether it's undervalued or overvalued. And there you see that currently we do think that the rand is probably a little bit oversold. But the important thing to see here is that what you see is the orange line, which is the rand, the rand dollar, I didn't mention that. And then the black line is that unit labor of cost. The important thing there is they follow the same trend. So while we don't know what the rand is going to do in 3 to 6 months, what does tend to happen on a longer term is the rand does tend to, and if you peg it there where the orange line and the black line cross around, the block is blocking around, I think it's 2003, 2004, if you track that, it's about a 4% weakening per annum of the rand against the dollar if you track it over that long term. And that's how we tend to look. So if people ask us, well, sure, I want to invest offshore, but the rand weakens so much. What if it strengthens back and I lose some of that return? For us, it's just, well, an offshore investment generally is a longer term investment. And then, the rand, it's not such, there's other components. So, I mean, obviously the shares that you're invested in, but just the rand is not such a huge, it's not, over a long term, it's not going to be such a big detractor. I mean, if you buy now and you sell it at the end of the year and the rand goes, back 20%, strengthens 20%, that's obviously a huge impact on your return. But if you're investing for the 5 year plus, then it's not going to have the type of impact that you would be concerned about. So taking all of this together, these are our 4 asset allocation funds. So this is where we can look at everything and make decisions based on what I've just explained. So, our South African component, so we've taken in our asset allocation funds, the conservative, balance and flexible fund, we've got our maximum offshore, and what you'll see is in that offshore space, a lot of that is in equities. Most of that exposure is sitting in equities. We still believe that's where the better opportunities are. You're getting nothing in cash, and even more so now, getting very little in bonds. So really that going forward is the better opportunity in that space. And I think a lot of the calls we made, putting in protection for the against the S&P, that has assisted holding our offshore funds up. Other things like we've got a lot of exposure in Chinese internet companies, Chinese online companies, online shopping, and obviously through this whole coronavirus thing, those companies have actually done really well. So again, always remember, we're not invested in an index. We have this underlying exposure that may not be quite as negative as what the index looks like. We have in South Africa, and this is again, this positioning hasn't really changed much, is we've got quite low exposure to shares. So you can see there in conservative 26.5, in our balance 33%, and flexible. Now our flexible fund can invest anywhere in the world over any asset class. So it's not restricted to invest 70% of its exposure in South Africa, like our balance and our conservative fund is. So we call it Regulation 28 funds. Property, the equity exposure we have in South Africa is those big non-resource rand hedges. We like British American Tobacco, Anheuser-Busch, Richmond, those kind of companies. Those are the kind of names we like. Not a lot of South African Inc. shares, so companies that are only do business in South Africa. because we were, and again, this is a 4-year story, we've been concerned about the South African consumer, the consumers under pressure. We don't just want to hold companies that only, earn their money or earnings in South Africa. We want that diversification over the whole world. Property, we've been of the opinion, we've been quite cautious on South African property. If you look at if we look back, the consumers under pressure, retailers have been under pressure. Who knows what this coronavirus story is going to do for the likes of an Edgar's and that sort of thing. So from a retail perspective, we've been concerned about the consumer that's been under pressure, and hence the retail space in the property companies. Office space, Sandton City, which is the cream of the office crop, their vacancy levels went above 15% for the first time in 20 years. And I think the coronavirus has probably accelerated that trend. So companies have seen, people can work from home, we can zoom in. There's less meterage per person being occupied, so we can, there's other ways to do business. So this has probably accelerated that trend. However, we've just got a lot of exposure to a UK property company, Capital & Counties, which has again done quite well for us. So we're not in a lot of the companies that got really hurt when the property company, the shares fell. Corporate bonds, Balance has just had that, and it's the big 4 banks forever. Government bonds, so as I mentioned, you've got the Conservative Fund with that 23.7, Balance 17%, and even our flexible fund, which can go anywhere in the world, has got 16, almost 17% in SA government bonds. Commodities, it's physical gold. So this is the new gold exchange traded fund. So when the gold price goes up, then this part of the portfolio benefits from that. And it's just extra protection, because generally when there's volatility, uncertainty, there's a flight to safety, i.e. gold. So that's why we have that in the portfolio. And then the money market is the optionality. So it's when those opportunities present themselves, we're able to then utilize that money. And if we use that money and we still see great opportunities, then we can sell those bonds, the government bonds. And as I mentioned just now, that's why that liquidity is so important for us in this space. And that's my story. So the last slide is just the summary. So we've been focused on capital preservation for quite a while, and obviously high liquidity. And I think we've just realized this with this whole in the last few months, how important liquidity is, because you have to remain solvent when people are needing their money and that sort of thing. You don't want to be stuck in something you cannot sell. You need that liquidity from a risk perspective. And this is just a summary of everything I mentioned previously. And yeah, that's my story. So if there's any questions, I'm happy to take them.
Thanks, Karen. Yes, we've got one question. You'll see it at the bottom of your screen there. It's just a question to say, what is your view on Sasol, or what is Foord's view on Sasol?
So we have Sasol. Yeah, so the thing is, it's just, so we have what we call a multi-counselor approach. So what happens is each fund has more than one portfolio manager. You've got sort of 3 or 4 or 5 in some of the portfolios, managers managing the money. And so I can tell you that, some of the managers, and that's the thing about multi-counselor, is because we believe that individuals make better decisions than committees. If you've got 5 people and 3 vote for, you have a majority, and you have to go with the majority. We believe that we've hired intelligent people, and they should be able to make that decision themselves. So some of the portfolio managers have sold out of their Sasol, but some of the managers have kept their Sasol exposure.
Okay, great stuff. Thanks, Karen. Let me quickly see. There's no other questions. Thank you for your time. I think it's been really, really insightful, and I think our clients got massive value out of this. I got value out of this, and it's good to know that we work with fund managers that actually go through a lot of processes and look at things maybe from a different angle. We believe in, and I know you guys believe in it as well. It's good to blend asset managers within portfolios. It's not just nice to use fund managers that all do the things the same. It brings diversification to our portfolios, and it brings a certain amount of protection for our clients. So it's good to know that you guys are taking a stance on government bonds, and our clients are getting exposure to those bonds through your portfolio. So once again, thank you for your time, we really appreciate speaking to our clients this afternoon.
Pleasure. Thank you very much for the opportunity. I really appreciate it.
Great stuff. Thanks, Karen. Thank you very much for joining us again this afternoon. To our clients, we appreciate it. I know we pressed for time, 1 hour, 2 seconds. Please schedule a meeting. If you've got questions regarding your portfolio, speak to us. We're here to help you. And if you want to just go to our YouTube channel. And like I said, we did that one about the 5 principles of investing. And it's just, once again, the importance of blending asset classes and asset managers, not trying to time the market, being in the market, upside as well as downside protection. It's really, really important. If you missed that 5 principles of investing, go to Good Forsure, Blue Star on YouTube. It is there under the live recordings. And thank you for joining us again. And we'll see you next week, Tuesday, same place, same time. Be safe. Thank you very much.